Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by a few of my colleagues. I've got Cris Dorides. Hey, Cris.
Hey, Mark.
How you doing?
Doing well.
I ask you that every week, and you tell me I'm doing well. That's good.
But yeah, let's hope I continue.
I know I'm old for that.
Doing well.
And we've got Marissa. Were you here? You were AWOL.
No, I was. Yeah, I've been vacationing, Mark. Sorry about that.
Oh no, that's fair enough. I know you were in Hawaii. I mean, boy, what a mess.
I know. I wasn't on Maui, but it's really
so
sad.
The funny thing is, I was there this time last year.
Yeah.
Well, a little less than a year ago, Lahani, and I'll have to say I'm pronouncing that wrong, but the town that got destroyed, and they had this restaurant called the Lahani Grill, and I'm not exaggerating. It may have been the best meal I've ever had in my life. It was so good. It was just so good. It's such a shame. I feel so bad for those folks. I mean, what a tough thing. Really tough. And we got Bernard Yaros. Bernard, good to have you. You've become a regular, particularly when we've got the inflation numbers. This is the week for inflation statistics, CPI and PPI. So a lot to talk about there. Good to have you on.
Thank you.
You look like you're like in a 1950s movie, though. I don't know. What's that all about?
I don't. Yeah.
There's no color. I mean, what's going on?
I don't know. I'm in the lighting in the room that I'm in is kind of weird, and then I've got the Lume Cube, so I don't know what effect it's creating.
Oh yeah, you look like you're in a Alfred Hitchcock movie or something. Yeah. The birds.
Yeah.
There you go. Oh, we lost Cris for a moment, but I'm sure he'll be back. Hey, so the CPI, PPI, you want to give us the rundown on those statistics this week?
Of course, yeah. So the July Consumer Price Index, I would say, was good news all around. And just for our listeners, the CPI measures the average change in prices that are paid by consumers for a given basket of goods and services. And in July, the overall CPI rose 0.2%. And the core CPI, which economists like to look at because it strips out volatile food and energy prices, that also rose by 0.2%. Both of these growth rates were in line with our and consensus expectations, so there was absolutely no surprise here whatsoever. And while we should feel good about the July CPI, I am, there are some upside risks to the CPI that are lurking out there in the offing, in the near term. And that are tempering a bit of the optimism that I would otherwise be feeling. And right now, I guess my biggest future concern are in energy and food prices. So for the month of July, gasoline prices were really only a minor support to the CPI. They were up only 0.2%. However, in August, gasoline prices are rising. The national average of regular unleaded gasoline is 30 cents higher than it was a month ago. And also, if we look at wholesale gasoline futures, which typically lead retail gasoline prices by about 2 weeks, they're also on the rise and suggest that retail gasoline prices are going to head higher throughout the rest of August. So that suggests that we're going to get a bigger contribution to the CPI from gasoline in August than we did last month. And also elsewhere within energy, the price of energy services, so think electricity, utility, gas services, those prices fell by 0.1% in July. But also natural gas prices have risen to a six-month high in August. And if that continues, that's also going to show up to a greater degree within the CPI for energy services moving forward. There's spillover effects from energy into the other most important essential good that we, whose prices we interact with, on a weekly basis, and that's for food. So last month, the CPI for food increased by 0.2%. It wasn't, really a big surprise. I think one interesting development was that the CPI for food away from home, so this would be the prices you pay at a restaurant, the CPI for food away from home rose at its slowest pace. Rose at its slowest pace since March 2021, and this is probably just because wage growth in the food services industry has been relenting meaningfully in recent months, and it's no longer putting as much upward pressure on the menu prices that consumers are seeing at the restaurant. So while this was a good surprise. I think we are due for an unwelcome upside surprise in food prices in the not so distant future. And that's just because you look at, again, another energy price. If you look at the spot price for diesel, that has risen sharply in recent weeks to its highest level since early February, late January. And diesel is the absolute workhorse fuel of the agricultural industry. We use it to power the farm equipment, to pump irrigation water, and to transport farm produce. So diesel prices typically lead grocery store prices, or what we would like to call the CPI for food at home, by a few months. So if we get further increases in diesel prices, I'm concerned that that's going to push up on food prices. So I'll
Hold
stop
on,
there.
Bernard. Yeah, wait. I mean, it seems like you're going to the negative almost, I mean, right away without even talking
Yeah.
about the positive. I mean,
I'm just looking ahead. There's
well,
stuff that's
okay,
making,
all right, but
yeah.
come on. I mean, that CPI report was great, wasn't it?
It was great. No, it was great. It
Okay,
was
come
great.
on. Let's just dwell
He,
on
he
that for a
said that.
little
He led
bit.
with that, Mark.
Huh? He did.
He
I
led
guess
with
for
that.
like 5 seconds, and then he's off and running about oil prices and food prices. Everything's going up. I mean, come on. All right, come on. Let's just take a step back. And by the way, we lost Cris. I don't know what happened to Cris. But hopefully he finds his way back, to the podcast. But I know we've been having all kinds of power outages, here. And I know because we had terrible storms. Here he's coming back in, and I think he lost internet connectivity for a while, so that might be part of it. Okay, Bernard. Okay, tell me. I mean, what's the fundamental point here, though? The fundamental point is what? Inflation's
coming down. Inflation's coming down. It's
okay.
Yeah.
All right. Okay. And why is it coming down?
Well, a lot of so if we're just looking at, again, if we're looking year over year trend growth in the overall CPI, that's come down from little under 9%, almost a year ago, and it's now at about, just a little over 3%. So there's been a lot of moderation in inflation. And as we will talk later in the podcast, we've gone this moderation in inflation without a significant rise in unemployment or a significant deterioration in the labor market. So we've really been able to achieve a lot less inflation without worse outcomes in the real economy.
Yeah, and I should have said up front, because you alluded to it just now, just so the listener knows, we've got another guest, someone from outside, Sebnem Kalemli-Ozcan, and she's a professor of finance economics at the University of Maryland. She's going to be joining us a little bit later in the conversation, and we've already recorded that part of the conversation. So that's what you were alluding to.
Yeah.
We lost Cris again. I mean, I don't know what's going on, but okay. So broadly speaking, it feels like inflation is moving in the right direction here.
Mm-hmm.
And when you look at the components, and abstracting from, a lot of that year over year improvement in inflation is energy, the decline in energy prices compared to a year ago. They are, as you pointed out, they are starting to rise again. And that's looking to, to the future reports that we're going to see here. But even abstracting from the energy prices, we're seeing, a broad-based moderation
Exactly.
in inflation. And do you have a sense of, I'm going to ask one more time, and then I'm going to turn to Mariska and get her sense of it. Fundamentally, what's driving this moderation in inflation? If it's not, unemployment hasn't risen, it's not like the economy's growth rate it's moderated with the Fed rate hikes, but it's still pretty solid growth rates. I mean, we're still getting solid job growth, and GDP in the first half of this year was close to 2%, which is close to the economy's potential. So what's going on here? What's driving this fundamentally?
I would say it's the unwinding of a lot of pandemic-induced supply chain stress. So that's showing up in core goods prices. And then it's also the fact that shelter prices, so the cost of housing for renters, and then homeowner, the hypothetical rent that homeowners would pay, so that's owner's equivalent rent, that has peaked and is starting to come down, and we're expecting that to really come down further. So I would say these are the two key elements that have allowed us to achieve this disinflation without worse labor market outcomes.
Got it. And Marissa, so what do you think? Is that
That's the
concur?
correct answer. Yeah.
That-
I think.
Okay. Yeah.
Yeah, it is the unwinding of everything that's happened over the past 2 years with the pandemic and the Russian invasion of Ukraine, further exacerbating supply chains that were already mucked up during the pandemic, right? So it's just all of that coming back down to earth.
Right. Okay. Now, the other alternative explanation is demand side push. The fiscal stimulus provided by the American Rescue Plan back, well, over 2 years ago now. What do you think? Is that playing a role here, or not? So maybe on the margin, not so. How big a deal is that, or not?
That was more of an issue. That was more of a role that played more of a role last year, whereas this year it's
Okay.
not as much.
It's hard to connect those dots.
Yeah.
Over now, almost 2.5 years after the fact.
Exactly.
Right?
Yeah.
Because that was passed in March of 21. That piece of legislation.
Exactly. Yeah.
Okay.
I think that staved off a deeper downturn than we would have had, had that not passed. But I think at this point, middle income, low income households have likely blown through all of the excess saving that they had during the pandemic, and including stimulus money that they got. So now we're really seeing the impact of stripping that out, right?
Right. I'm sorry, I'm a little distracted because Cris keeps coming in and out.
Popping in and out.
He's popping in and out. And he's trying different things. You can tell, he's trying different things to get into the podcast. So I think he was on his phone the last time. Okay, so let's go back, Bernard, to your rundown, and let's just explore that a little bit more. So what you quickly got to was, look, yes, we've had all this great inflation news, but it feels like it's going to get a lot harder to get inflation back all the way down here. So inflation is sitting in terms of CPI, Consumer Price Index. It feels like it's top line is around 3. The core is still higher than that, still 4.5 to 5. And to get it all the way back into something we all feel comfortable with, certainly consistent with the Fed's target, which for consumer price inflation is probably about 2.5%. That's going to be more difficult. And one of the reasons for that is this recent run up in oil prices.
Exactly. Yes.
Yeah.
It's a concern. I mean, I think for now it's a yellow flag. It's not. I don't think it's not something I'm too concerned about. But it's moving in the wrong direction.
Yeah, because it with oil now is sitting somewhere between $80 and $85 a barrel, depending on WTI or Brent. That's probably consistent with what, $4 for a gallon of regular unleaded, maybe a little higher than that, something like that. Is that right? And that is well above where we were last month, and certainly I think the low was $3.25, $3.50, something like that, not too long ago. So that's going to add directly to top line inflation this next month. When we get the next month's for month of August, next month. And then you're also making the point, well, this is also going to be an issue for food prices because diesel has gone up, and diesel is key to the cost of food. That's the point you're making. Okay, fine. But you're saying if we stay at $85 a barrel, this is great for the near term, but it doesn't derail this steady moderation in inflation.
Exactly. Yeah. Yep.
Okay. All right. Let me ask you another question, negative and positive. On the negative side, is there any other price out there that you're worried about? Any other, commodity or service for which you're fearful that that's going to pick up and make it more difficult to get inflation back in the bottle?
So the next risk I see out there, and this is probably going to be a podcast in September, is what's going on with the United Auto Workers strike against the big 3 U.S. automakers, Ford, Stellantis, and GM. In July, new vehicle prices fell by 0.1%, and this was expected in our bottom-up CPI forecast. We expected a decline of this magnitude, and this was expected because we have had a welcome spike in U.S. auto assemblies, especially during the second quarter. In April of May of this year, U.S. auto assemblies rose to a level that was even higher than its average for all of 2019, which was well before we had all of these pandemic-related supply chain disruptions. But if we do get a work stoppage, if the negotiations between the UAW with the big automakers, if that fails and it ends in a work stoppage sometime in mid September, there just isn't enough inventory to really keep prices from rising. So that, because that's going to affect auto production, which empirically we do see that that does have some effect on prices with like a 2 to 3 month lag. And it's important to remember that last time we had a UAW strike, I think it was back in 2019, we really didn't see that many major macroeconomic consequences, but that's just because the strike affected only one automaker, not 3, which could be the case this time. And we also weren't being impacted by reduced auto inventories, as is also the case now. So that's just one concern. But whatever upside we get to new vehicle prices, maybe in the fall or winter because of any potential strike, I think that should still be largely offset by the enormous disinflation or the enormous deflation that we will see month over month in used vehicle prices, which fell 1.3% in July. And that we should continue to see further declines in used vehicle prices just based on what we're seeing in auctions. Dealerships are just paying much less than they were before for the used vehicles that they then sell later to consumers.
Oh, okay. So what you're saying is another threat to getting inflation back in the bottle is new vehicle prices, particularly if the UAW strikes against all the automakers. But that should be offset in part or in whole by continued declines in used vehicle prices. Is that
Exactly?
What you're saying?
Yeah. Yes.
Okay.
At least through the early fall, I would say.
Yeah. And of course, these things presumably UAW, if there is a strike, it isn't going to go on for a length. Well, it could be a few months, but that probably not longer than that. So this may be an issue for the second half of this year, but as you make your way into 2024, not so. It's just the opposite, you would think.
Yeah, exactly. Yeah.
Okay. All right. It's not great though. Hey, Marissa and Bernard, I'm going to come back and ask you if there's any other components out there that make you more optimistic about inflation going forward. But before I do that, I'm going to turn to you, Marissa. Any component of the consumer price index, commodity or service that you're worried might add to inflationary pressures going forward? And you don't need to come. I'd be very happy if you can't come up with any, but I'm just asking.
No, I think even if we do inevitably see an increase in headline CPI because of energy prices, I think that the Fed will look through that. And I think they're really focused on core inflation. And in the July CPI report, it's really shelter is the key to really most of that, right? That accounted for 90% of the increase in core services over the month of July. So it's really hinging on what's going on with the housing market here, both owner's equivalent rent and rent of shelter.
Yeah. Okay.
So I'm really keyed in on that.
Yeah, I'm sorry. I'm kind of chuckling because I see Cris.
Chris is resorting to communicating.
He's got a little hand up.
Yeah.
He's got a line. We're obviously in Zoom, and so he's got a little hand up. Hey, Cris, and I know what you're going to say because you've got. I know it, but go ahead. Go ahead. Tell everybody what you're worried about.
Well, Mark, have you been to the doctor lately?
I knew he was going to say that. Yeah, I knew he was going to say. If he didn't say it, I was going to say it. Go ahead, Cris.
Medical care services.
Yeah.
Come on.
Yeah, exactly.
This is telling us prices fell 1.5% over last year, fell 0.4% over last month. This is a measurement issue. We've talked about this on the podcast before, but clearly this might be sending a little bit of a false signal, right? It's not a huge component of the overall CPI basket, but it's not represent. I do expect this to reverse, right?
This goes to health insurance. The way the Bureau of Labor Statistics, the keeper of the data, measures the prices for health insurance. Bernard, do you want to explain? I always botch the explanation, but do you want to take a crack at it? How the BLS measures this, or not?
So it was they're looking at, when the BLS tries to measure health insurance, they're looking at the retained earnings of health insurers. So during the worst of the pandemic, everyone was foregoing routine visits to the doctor. They weren't having, life threatening, or they weren't having necessary surgeries. So insurers weren't paying a lot of premiums, so their retained earnings really shot up. And I think in the year before, the health insurance CPI was really adding significantly to the overall CPI. But then this went in reverse this year as people were going back to the doctors. After the pandemic, everyone was going back for regular appointments, routines, surgical procedures. And then those retained earnings of health insurers was crimped, or was compressed. And then that has led to consistent, these are very sticky prices. They only really change, they're updated by the BLS like once a year. And this isn't going to be updated until probably later this year, around September, October.
I think October. Yeah.
So they've been consistently, health insurance prices have been consistently falling by about 3 to 4% month over month over the past 10 months or so. But that's going to come to an end. And once that does, that's also one methodological quirk that's been weighing on the CPI that's going to go away.
Yeah. So I think you see all these negative month-to-month numbers for the price of health insurance, medical care services, but that's going to become a positive. I think it's in the month of October. And now, instead of being a drag on inflation, it'll be adding to inflation.
Exactly.
And it's more of a deal in the consumer expenditure deflator, the PCE, which is obviously important because that's what the Fed core PCE is what the Fed looks at. And this plays a much more, the weights are much higher, and I won't go into the reasons why, but much higher in the PCE than in the CPI. So this will be, a bit of a irritant, in terms of getting inflation back in. Okay. Let me ask you this, as I said earlier, let me ask you this. Is there any component, commodity, good, service that may surprise us in terms of helping us out here and getting inflation back in, Bernard?
Yeah, I think one surprise this month, and it probably will continue, was and it was one that I mentioned earlier on, was the CPI for food away from home, so restaurant prices, because that had been rising pretty strongly. And I really think that this was tied to just strong wage growth, especially in the food services industry. And this was an industry that really was suffering from high turnover, from a lot of job openings. But we're seeing wage growth in that sector really moderate significantly. And I think that's starting to finally, relieve a lot of that upward pressure that was on this particular category of the CPI. And just generally it just highlights the importance of wage growth for especially for services. Because empirically you do see a strong relationship between wage growth, between excess labor demand in the labor market, and a lot of these core services, excluding shelter components of the CPI and also the PCE deflator. So if we do get more moderation, more slowdown in the labor market, I think some of these categories of prices will start to moderate, and I think that should help us get back down closer to the Fed's 2% target.
Got it. Marissa, any components that would help out here?
Yeah, I actually just in my labor research piece this month, I wrote about the different components of wages across industries, and the industry that's had the biggest decrease in wage growth over the past year is leisure hospitality, which is where much of that inflation has come from, right, in the service sector. So wages peaked in the first half of last year at almost 9% year over year, and they're down to about 5.5% now, which is still elevated relative to where it was prior to the pandemic. But you're talking about, almost a 50% decline in the wage growth rate. So that should eventually work its way right through wages and then the prices consumers pay for food. And that is perhaps what we're starting to see a little bit of now.
Got it. Hey, Cris, are you there?
Yep.
Any positives you want to call out? I know that's not in your nature, but I'm just.
Oh,
just
wow, that hurts. I'll throw out shelter, right? The rents should continue to moderate here, but they're still pretty high on a month-to-month basis, even year to year. But you know, the private market indicators for new leases suggest decline, so that should bleed in, but it's not going to be immediate, right? It's going to continue to be a fairly lengthy process for the CPI to pick up these changes, but yeah, should continue to help get us down to the Fed's target.
Okay, so our baseline forecast, which assumes the Fed is done raising rates, the funds rates at the terminal rate, and no recession, soft economy, some small increase in unemployment over the next year, but no recession, has inflation, consumer price inflation. Top line is now a little over 3, the core is a little under 5. That by this time next year, they'll both be at the Fed's target at 2.5%. Bernard, what do you think?
I agree with that. If assuming our because I think our shelter for
okay.
Yeah.
Go ahead. Sorry.
Because right now, over this period of time, you're going to get significant housing disinflation, and rents account for about, if we're just looking at core CPI, that accounts for about over 40% of the core CPI.
Right.
And right now, rents are tracking at about 7.8% year over year. Our forecast is for that to fall to 6%, and then to fall below 3% by the end of next year. And I think that's doable. I think that's that's to be expected given the weakness that we're seeing in leases for new tenants thus far. So that's really going to pack a big punch when it comes to just allowing for the CPI to disinflate closer to the Fed's target over this period of time.
So you're on board with the baseline?
Yes.
Okay, Marissa?
I am. Energy prices, if they remain elevated and they keep going higher, that could mess us up a little bit, but
yeah, barring that,
yeah.
Cris?
Well, in the absence of a recession, I think it actually might take a bit longer, right? For the reasons we described. So I think maybe a quarter or two to really get down to the Fed's target.
So you're saying the end of next year?
So that's end of next year. Yeah.
Okay.
Unless we have recession or greater weakness, right? Then certainly that would speed things up.
Right. Okay. All right. Well, of course, I'm on board with the baseline. I'm all in on the
baseline.
It's my baseline. Yeah, I think I
hope so.
I think we're on track. I do think this so-called last mile will be a little difficult. It's going to be 2 steps forward, 1 step back. But I do think by this time next year, we should be back close to that 2.5% target on CPI. Okay, let's play the game, the statistics game. That is, we each put forward a number. The rest of the group tries to figure that out with questions and clues, deductive reasoning. The best statistic is one that's not so easy, we don't get it right away. One that's not so hard, we never get it. And if it's timely and apropos to the topic at hand, which is inflation, all the better. Okay, Marissa, you're up. This is tradition. We always begin with you. So what's your statistic?
My statistic is 77.4.
77.4. Is it related to the inflation data?
No.
Is it? No. Is it a statistic that came out recently?
Yes.
Is it the University of Michigan survey?
It is.
Okay. What component is 77.4? I think the overall is 71.4. Although Marissa is prone to getting negatives and positives wrong, could she be possibly gotten the 77 versus the 71 wrong?
I am not prone, Mark.
No, you're not. I jest. What? Okay, guys. What in the
is that present situation?
It is. It's the present conditions index,
conditions.
Perception of present conditions from the University of Michigan Consumer Sentiment Survey. This was the August reading on present conditions, which maybe isn't that interesting in and of itself, but I picked it because this has risen for 3 months straight now. We're on a very downward trajectory, right? It's still very low compared to where it was prior to the pandemic. But in the past 2 months, for the first time, the present conditions index has risen above the low point that it reached right when the pandemic started. So when the pandemic started in March of 2020, this plummeted. And starting in 2022, this University of Michigan survey has just been completely in the dumps, lower than it was in the bowels of the pandemic, right? So now for the first time, it's above that pandemic low, which I guess is good. I mean, it's a low
moving in the right
bar, but
direction. Yeah.
it's still well below where it was prior to the pandemic.
You know what I noticed in that report was the inflation 1 year ahead inflation expectations. Did you notice
I was
that?
considering making that my statistic, but
yeah, that would have been a good one. 3.3%.
Yeah.
Which is not too far where I think you'd want it to be for consistent with the Fed target. Because if you look historically, in a time when inflation's right where they want it, it's about 3%. So we're within spitting distance of that kind of expectations number that would be consistent with the Fed target. That was good. That was very good. Okay, Bernard, you're up.
So my statistic is 91.9.
91.
that sounds like an index.
Small business index.
Oh, it's NFIB.
Exactly. Yep.
Yeah. Marissa, I beat you to it. I wanted,
That's debatable. We'll have to replay the tape.
Oh, come on.
Yeah.
Come on. replay. That is the overall index, right?
Yeah. So I didn't want to go into some of the details there, but I didn't want to give some of the detailed statistics underneath. But one thing that is interesting about this index is it really speaks to this so-called vibes session. Everyone thinks we're in a recession, but they're not acting at all as if that's really the case. And there's about 10 components to the NFIB index, and about half of them are what you can call hard data. So these are asking small businesses, what are their plans for employment, for capital expenditures, for inventories. There's also, asking about their current job openings and earnings. And if you just recreate a hard data NFIB index, that's it's in positive territory. It's consistent with an economy in expansion. But then if you take the other components that make up the NFIB index, which are more about expectations, these are more soft data, and you just compile them together, it's about as low as it's ever been in, going back to the mid 80s, even lower than the great financial crisis. So the Main Street, businesses on Main Street, they're very pessimistic when they look at the outlook. But when you ask them, what are they doing? Are they planning to raise employment? Are they planning to make capital expenditures? If is now a good time to expand, or how many job openings do you have? It's still pretty solid. All of this looks good, and this is important because they account for a significant share of employment, private employment. And I think that's why everyone was looking at a lot of these negative sentiment. But when you actually looked at the action, and people were looking at these negative vibes coming out of consumers and businesses and saying, we're headed for a recession. But when you actually looked at their actions, it told a much different story. And I think that's why we've been holding it together strongly.
Yeah, I just, it's so interesting, this dichotomy between the hard data and the soft data. You can see that in all these surveys, the ISM survey, that's the purchasing manager surveys. And even in our survey we conduct, we have a survey we do every week of businesses, and you can kind of feel it there. The kind of the broad atmospheric questions, they're very, very negative. The specific questions about jobs or investment, they're fine, no problem. So it's just, I find it so fascinating. And maybe we should do a podcast on that, maybe get a behavioral psychologist or something. What the heck is going on? I mean, I've got theories, but I find that so interesting that's the case. That was a good one. Okay, Cris, you're up.
All right. My number is 2.1.
2.1. And is it an inflation statistic?
It is not.
Ooh.
Oh,
You should, if you don't get this mark, I'm going to be very.
it's a house price. Is it a house price index, Cris?
Nope, it's not.
Is it a delinquency rate?
Nope. It
What
is
are the
actually an
units?
indicator that you cover, Mark.
Oh, I know. Is it our business survey?
It is. It is.
Ah,
It's
okay.
the Moody's
Yeah.
Analytics
Okay.
Survey of Business Confidence. You just mentioned it.
I just mentioned it. Yeah. Yeah. You want to explain?
Maybe you should explain because you cover it. It's a diffusion index.
Yeah. I've
right?
been covering it
2.1 is
since
up.
2003, by the way. That's when we first started that survey. Yeah. This is folks that are clients they don't have to be clients. So you can participate in the survey. It's a weekly survey. We have 9 questions. And, I mentioned there's some atmospheric questions around how do you feel about, current business conditions broadly? How do you feel about the future 6 months from now? And then specific questions about hiring and investment, inventories, office space, finance, availability of financing, those kinds of things. Then we create a overall index, the percent of positive responses less negative, that diffusion index that Cris just mentioned. And it's slightly on the positive side, which is, it's consistent with an economy that's kind of sort of treading water, not in recession, but, certainly growing below its potential. And, it kind of feels sort of like where the economy's been. But again, it feels like it's being weighed down a little bit by the atmospherics, the kind of the soft data, so to speak. But that's a survey that, we've been doing for 20 years. And I encourage people to look at it, participate. That would be, it's always important to have high level participation. So we'd welcome that. And you can do that off our Economic View website, the EV website. Did I get that right, Cris? Did anything I missed?
You did. No, you got it. It's free.
All
to
right. I
participate,
nailed that one,
and
baby. Yeah.
it's free to participate, and you'll get a report on it every week that you do. So there's a little give to get if
They give to
you're
get.
interested
Yeah.
in participating.
Right. And I do find it very valuable, particularly interestingly enough, the percent of respondents to the question about present conditions. How do you feel about your business and how it's doing right now broadly? The percent that respond positively, that's like in my mind, the most useful in terms of gauging where you are in the business cycle. And we're right kind of on the edge of no recession, economy that's just kind of skirting its way through. And it's global as well. So you might find some value. That was a good one. Thanks for calling that out, Cris. All right. I think I got a pretty good one. 2.5%. This might be a little harder.
Related?
Inflation related.
Oh, that's less. What is it? Less energy, food, and shelter.
Oh my gosh.
Yeah.
You're a god.
Yep.
That is great,
Yep.
Cris. I was afraid no one was going to get it. I thought you nailed it. Perfect. So
because I saw that number 2.5, I said this matches perfectly with Mark's narrative. He's gonna watch out of it.
Okay. Come on now. Listen, year over year through the month of July, CPI core, so exclude food and energy, take out the shelter component, it's 2.5%, which is the target, the Fed's target. And the only reason we're not at target, if you buy into that measure, is the cost of housing, the growth in the cost of housing services. And as we've been discussing, we all know that that's going to slow quite dramatically here. In fact, we forecast lots of stuff, some of which we're very confident in, some not so much. This we were pretty about as confident as you can get in forecasting anything because it's tied to rents with a long lag. Those market rents are flat to down, and then we know that's going to translate into slower growth in the cost of housing services over the course of the next year. Thus, my baseline forecast a year from now, growth of cost of housing services is going to be normalized. It's going to be around 2.5%. And the overall index, the core index, is going to be at 2.5%. We're going to be at target, right? Isn't that compelling? That's a compelling argument.
What about those medical services we just talked about?
Yeah, but all those other things, you got cross currents. You got medical services inflation going up. You got electricity cost inflation going down. You got new vehicle prices maybe going up briefly for UAW, but got used vehicle prices going down. All those other things, things obviously can happen between now and then, but barring something really going off the rails, all those other things feel like they're a wash. Some add, subtract. The net of all that is, no big impact. No, that's not. I mean, I looked at that and I go, oh my gosh, I couldn't believe it. Very consistent. Marissa, what do you think? You convinced?
It is. I
It's
wonder,
compelling.
I wonder about shelter costs. Does the OER component of shelter tend to lag rent?
Okay.
Because
OER
owner's
is
equivalent rent. So
right.
it's the implicit rent that a homeowner would get for their home were they to rent it, essentially. So it's an implied calculation.
Yeah.
And I just wonder if you really need actual rent to moderate before that sort of works its way into the OER component.
I think the answer is yes. I mean, the market rents are a basis for them constructing the owner's equivalent rent. So it's a complicated, like everything in the CP, like every data statistic, I guess, a very complicated, process from going from rents to measured prices. But that's effectively what they do. Bernard, right?
Yeah, they generally, and you generally see tenants rent and owners equivalent rent.
They move the
largely
same.
in the same. Yeah.
Yeah.
At
They
the
try
same
to get rents for homes that would be more consistent with homes that people own, so they try to line that up to make that work better. But they still ultimately goes to rents. Yeah.
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 Because
Here's the other
OER
thing.
is the bigger component of shelter.
Yeah, by far.
So-
Yeah. Because 2/3 of people own their own homes, 1/3,
Right.
rent. Here's the other interesting thing that, if you think about it for a second, you go, oh, and it's important, for people who own their own home, right? 2/3 of the population, they either own a home outright. I think half of people own their own outright, and half of people have a long 30-year, 15-year fixed rate mortgage. Very few people have mortgages that adjust with market interest rates. So their cost of housing, the actual cash they're shelling out to pay for their housing is not changing. It's not changing at all, right? The cash outlay is not changing, but their cost of living is increasing as measured by the OER. So the actual economic consequence for their finances is much less serious than, if I have to actually shell out more for food or for apparel or for gasoline. I'm shelling out more cash. In this case, you're not, right? Isn't that interesting? I mean, you go, duh.
Yeah.
It just sort of dawned on me, Cris, right? Am I missing something?
So that's right. I guess it would apply for, well, to some extent for cars too, right?
Yeah, that's true. That's true too. Yeah, true too.
On your own.
Yeah, you're not. Yeah,
As you say,
Yeah.
the CPI has a lot of complexity in it.
Yeah.
I think we summarize it and we use a lot of shorthand, but there's a lot of detail here in both how it's measured and how to interpret it.
right. Anyway, well, that was a great conversation about the inflation statistics. I think we covered a lot of ground. I think we, at this point, better move on. This is going to be a very long podcast because we have a great guest. And let me welcome Sebnem into the conversation. Sebnem, good to see you. How are you?
Good to see you, Mark. How are you?
I am very well, thank you. And we met a couple 3 months ago at the New York Fed. That was a lot of fun.
Yes, definitely.
We're both on the, I guess it's called the Board of Economic Advisors, or just
Yes,
advisors?
yeah, exactly. Economic Advisory Board. Yeah.
Right. And this is a board of advisors set up. I guess we meet a couple times a year, maybe more than that.
Yeah,
And-
yes. So it was, I think, 4 times before COVID. During COVID, it went down to 2 times through Zoom. Yeah. So we are still in that phase, I believe.
Right. And we talked about, it was a couple 3 months ago. So top of mind at that point was the banking crisis. And I want to come back to that. But before we kind of dive into the subject matter, maybe you can give us a little bit of your background. I'd love to know a little bit more about your success and how I should say you're now a professor of economics and finance at the University of Maryland. And I'd like to know a little bit more about your background and how you got there.
Sure. I actually, I'm originally from Turkey. I went to college in Turkey, Middle East Technical University, and then I came to United States in 1995 to do my PhD. I did a PhD in economics at Brown University in Providence. And after that, so that was, 2000. So I got my PhD 2000. So last 23 years, I have been busy doing economic research, trying to get tenure and all that. And at the same time, visit policy institutions. So my work is in what we call macroeconomics broadly, but it is international finance and international macroeconomics. So, and it's very policy relevant, applied to policy. So I work on things like transmission of US monetary policy to other countries, inflation, capital flows, globalization, those type of issues. I started at the University of Houston, actually. At that point, we moved there in 2000 with my husband. And then, I had my kids there. I have two sons. Now they are 21 years old and 16 years old. They are now, really old. I'm remembering those days when they were little. So then I was at the University of Houston for 10 years. After that, I had stint at Harvard Kennedy School. I was at European Central Bank right around the entire big crisis of 2007, 2008. I remember actually being at European Central Bank, and the chair then, Trichet, was saying, "Oh, this is just a little thing in the United States. It's not going to come here. It's just a little."
I remember that.
Yeah. And I'm like, that is just not possible given the extent of global financial linkages, because that is my area of expertise. Anyway, so kind of we did a lot of work on that. We wrote.
Wasn't he raising? As I recall, like right in the teeth of the financial crisis, they raised rates, as I recall, right?
No, exactly. It was just like,
yeah. What are you thinking?
Yeah. Everybody was like running around like headless chicken, right? Nobody knew what they're supposed to do. He was saying things like, "Oh, Ben Bernanke and I, we were talking every day." But that was actually the key moment for my research, in a sense that I saw how important and relevant my research for policy is. We wrote the first piece that shows the exposure of European banks to Greek debt. And this data, which is now very well known, BIS, Bank of International Settlements data, was sitting there at the European Central Bank. Nobody was using it. Nobody even knew it was there. I mean, you would think, okay, if you're integrating several countries, you want to know the exposure of your banks to other countries' debt, right? That would be the first thing you would want to know about. Anyway, so this came out in Journal of Finance, which is the top journal in finance. So we published there. Then of course it became very fashionable. I mean, this is 2008, 2009. After that, I came back. I was in Turkey also visiting a couple of universities there, Koç University, Bilkent University. Then I came to University of Maryland. I have been in University of Maryland last 11 years, since 2012. And, it has been great. I, had a lot of time because I was at University of Maryland, spent at IMF, World Bank, Federal Reserve. I visited all these institutions a long period of time, which helped me a lot to understand the linkages between academic research and policy application, how important it is to bring the state-of-the-art knowledge from academia to policy folks, right? Call it IMF, call it Federal Reserve. And, this is where I am right now. So I wrote a paper for the Jackson Hole Conference in 2019 on the spillovers of US monetary policy. That became a big hit. And then, now, I'm here doing my research.
Very cool.
Enjoying. I am actually now going to move again next year, 2024. I am going back to my alma mater. I'm going to be a professor at Brown University starting September 2024. Yeah.
Congratulations. Well, good. And thanks again for joining us. I know that you've done a lot of work with regard to the recent banking crisis back in March. In fact, you gave a presentation at the New York Fed with President Williams was there and the rest of the Fed staff. And here we are 3 or 4 months after that crisis, and it strikes me that the impact, the fallout has been rather modest, in the grand scheme of things. I mean, if you look at, yes, the banks have tightened up on their underwriting standards. If you look at the senior loan officer survey that the Fed conducts every quarter, that shows a further tightening in underwriting. But in terms of its impact on actual lending activity, is you can go look at the Federal Reserve's H8 release, which shows the assets that the banks have and kind of gives you a pretty good sense of their lending. There's been some weakening in commercial industrial lending, C&I lending, but in terms of commercial real estate lending, multifamily lending, construction land development lending, it doesn't, looks it's slowed, but, hasn't really fallen off to a significant degree. And also deposits, after an initial decline back in March, they appear to have stabilized both for large banks and smaller banks. So I guess the question to you is, am I characterizing this right? Are you coming around to the same conclusion? And what do you think's going on here?
Yeah, no, you're exactly right. And if you remember that presentation at New York Fed, Mark, one of the things I was saying, at that point, we don't know if this is going to really turn out to be a huge scale banking crisis like the 2008 version. But my expectation at that point was it wasn't going to be. So basically, I predicted the situation. And that expectation and prediction is based on the fact that I look at granular data. I mean, this is what my research has been. I look at these linkages between the real sector and the financial sector, but not just say, the entire corporate sector and the banks or the commercial real estate and that. This is literally at a granular level. So go and ask question, where does Mark and Sebnem borrows from? So, what is in Mark's portfolio, Sebnem's portfolio, or Goldman Sachs portfolio, or, Apple's or Amazon?
I hope you don't know my portfolio. Hopefully you don't know my portfolio, Sebnem. I'm just saying. Yeah.
The point is, you have to do it at a very granular level. The problem is why people got panic and said, okay, this is going to be big. I mean, the economy is going to slow down and all, because everybody thought, well, this started in regional banks, in the small banks, but there can be two things that can go very bad. One, it's just a contagion, right? Everybody's going to panic, and now this is going to show up in Bank of America's of the world, JP Morgan's of the world. Number one. Number two, these guys are the regional small banks, and small firms borrow from small banks, and then this means once those firms go under, there's going to be a huge impact on employment because small firms are the bread and butter of the economy. Okay, I explained in that presentation, first of all, this is not correct, right? I don't know why, but it is just very deeply ingrained thing in people's minds, because people only look at Apple's and Amazon's of the world, like listed firms and CompuStat firms. And then, so these kind of large guys, and then jump from that to the conclusion that, small guys must be borrowing from small banks. This is not true. US economy is super heterogeneous. And unless you look at literally every single small firm, every single small and big agent, Mark, Sebnem versus Apple, Amazon, or this 100 employee firms versus 3,000 employee firms, you wouldn't know who is borrowing from who and who is exposed to what, right? Same goes for the banks, right? We understand these small regional banks like SVBs of the world did take interest rate risk, right? They didn't do their diligence, which we can link back to regulatory failures. But the bottom of the fact is there are other banks in the economy, large banks like Bank of America, they are subject to regulation. They didn't take that much of this risk, and small firms do borrow from those banks. So in fact, the results I showed in that meeting is from our work, not rely on H8 data. You said at the beginning, people were looking at this H8, some commercial loans. These are all kind of these.
Just to stop you for a second. So the H8 is the data that the Federal Reserve puts together on bank balance sheets, their assets and liabilities, and they release this every week. But so it's an aggregation across.
It is an aggregation, exactly. Not every bank is in it. That's the other.
And not every bank's in it. Right.
The big advantage is going to be that is something that moves high frequency, weekly, quarterly. So people just go and rush to H8 or data sets like that, because to find out the information quickly. But the big disadvantage is not everybody in it, so it doesn't cover every single bank, and it's not going to tell you anything in terms of which firm, which company borrows from which bank. That is the data called Y14, which is also Federal Reserve's regulatory data. We work with that data. This data has been started collecting after Fed started collecting this data after 2008 crisis, exactly because of the purpose of we want to understand where the risk in the economy and how like these isolated risks like the subprime of 2008 can be systemic risk, right? Can become like economy-wide. So we work with that data, and that data, is going to cover a large set of almost universe of the firms in the United States, a representative data set. So you would know the guys with less than 500 employees, what we call SMEs. And at the same time, you still will know the guys like Apple and Amazon. And you have a more complete picture who borrows from who. And when we look at that data set, going back to my presentation at the New York Fed, we see that small guys borrow from big banks. So which brings me to the point that as long as these regional stress, banking stress, like, SVBs, don't, jump to the big banks, as long as the big banks' balance sheets are safe, we are not going to have a crisis because small guys are still borrowing from the big banks, and small guys have very strong demand. Remember, this is the other point I make. Unfortunately, in this literature, in this topic, we think a lot from the supply side, supply of credit side. So, if banks are in trouble, they are doomed, right? This kind of was the case in 2008, but of course, all banks were under trouble then, right? All banks, not just like SVB and First Republic and all that. We have to understand there is a boom side to this picture. There is a side when we are not in a financial crisis, when not all banks are in trouble, the boom, meaning the demand matters a lot, the customer demand, the credit demand, and that's the situation we're in. This is the situation Fed is trying to slow down now over 15 months. Still not there. We have a strong economy. Demand is strong. If the customer demand is strong, that firm is going to go and demand credit. And if a safe bank like Bank of America wants to give that credit, then you don't have any problem. So this type of heterogeneity is very important to understand, Mark.
Okay, so what you're saying, just to summarize, is the fallout from the crisis has been modest, and one of the key reasons for that is that small businesses have been able to get credit, because if you can take a closer look at the data at a granular level, as you said, you'll see that small businesses are also borrowing from the big guys, the JP Morgans, the B of A's, the Wells Fargos, and continue to have access to credit, and that has allowed them to continue to operate and allow the economy to move forward. That's kind of the message that you're
Exactly. Got it.
Well, let me ask you this. So one concern is that, of course, the Federal Reserve had to respond. Fed, the FDIC, Treasury responded, guaranteed the deposits of whether folks are insured or uninsured, in SVB and the other troubled banking institutions. The other thing that the Fed did was establish a funding a facility to allow banks to borrow against their security holdings, and they could value the securities at par, not at their lower value given the higher interest rates. And that program is still in place, and it's, if you look every week, you can see that data as well from the Fed every week. The so-called H4 that continues to increase slowly but surely over time. So it feels like the system is still under a fair amount of stress. And one concern is that given the Federal Reserve's very aggressive rate hikes and the inversion of the yield curve, that banks are under a lot of pressure because their net interest margin, their difference between their funding costs and their lending rates, is under pressure. Now, they've been able to manage that, particularly the big guys, as you point out, have been able to manage that, up to this point in time. Net interest margins have held up pretty well. But as time goes on here, it gets increasingly more difficult for banks to do that. They hedge, they match, but that gets very costly, very difficult to do. So their net interest margins come under increasing pressure. So if the Fed has to keep its foot on the brakes for an extended period, the yield curve remains inverted for an extended period, The worry is that the banking system, which is still under a lot of stress, the Bank Term Funding Program continues to be used at a very high rate. Something's going to break in the system. Is it? What do you think? Is that concern overdone, or is that a reasonable concern?
No, it is definitely a reasonable concern. You're exactly right. But at this point, as you said, Fed has just underwritten the entire banking system, right? I mean, that's those policies did. And yes, we can look at, who is using those, who is withdrawing from that and all that. But that's the guarantee. Now, of course, that was a emergency panic moment, underwriting. We shouldn't be doing these things like that. Now, of course, I mean, this is why if you were following the entire media coverage of this, emerging market banks were laughing their head off, right? Because it's emerging market banking 101. Nobody would do this. I mean, you wouldn't have an emerging market bank. Remember, Brazilians were saying this, that would take this risk, right? I mean, you are in a tightening cycle. Every emerging market bank would know what would they do in a tightening cycle and a loosening cycle. So clearly, this didn't happen in the United States.
You're saying that this is banking 101, meaning no one would have gotten caught with this interest rate mismatch problem.
Exactly. But it's called interest rate risk. You wouldn't, because you would crash and burn.
Right.
And of course, they learned it the hard way. I mean, all these countries went through banking crisis because of the similar situation, and especially in those countries, because inflation is more volatile, you go to these easing and tightening cycles of monetary policy more frequent, right? So they learned the hard way, but also regulation came. I mean, after banking crisis, if you look at emerging markets right now, all the banks are regulated, all. It is not like the United States where you have these 50 guys, the big guys are regulated, which is how we get the data, the Y14 data, and the rest is not. And of course, in the United States, we have a huge number of banks, right? We are talking about, 3,000, 4,000, whatever. I mean, we came down from 15,000. So I guess, so that's over the last 30 years, but still it's a huge number of banks. There are a lot of small banks and they are not regulated. The way out of this problem is every bank should be regulated. I mean, I say this all the time. There are other people inside the Fed and outside sharing this view. This is what we learned through the bread and butter of banking crisis in the emerging market world. You regulate everyone. I mean, the minute you have these type of, okay, I'm going to regulate large guys because large guys are the systemically important guys. I will let the small guys be because they are small and regulation is costly for them. These things are going to happen.
Well, they're regulated. You're saying they have the same regulation, the same capital standards, same liquidity requirements?
You can think about that. You can fine tune that. You can fine tune and think the regulation in a counter-cyclical way, in terms of proportion to their size. But basically, you should have, they should have been prevented from taking this type of interest rate risk on their balance sheet during a tightening cycle.
Okay, so they're regulated, but you're saying they weren't regulated significantly enough. They didn't.
Yeah.
Okay, so the Silicon Valley Bank shouldn't have been able to do what they did.
Exactly, because the interest rate risk exercise, if you look at the other guys, the big guys part of the CCRA, that's the stress testing exercise, and the big banks part of that. When I say regulated, I'm using I'm using terminology here. Sorry about that. But when I say regulation, I'm talking about the regulation that the large guys, large banks, Bank of Americas of the world are subject to. The part of that regulation is this interest rate risk, right? These exercises run right for them, right? That's why they have a very diversified balance sheet. They don't have this type of low returning asset completely filling up their asset side of their balance sheet, right? Because they are subject to this type of stress testing exercise, and interest rate risk is part of that during a tightening monetary policy cycle. Now, this wasn't done for the small guys because small guys, they weren't part of that. So this is what I'm saying. When I say regulated, everybody should be regulated for all sorts of risks, basically. And this is such a plain vanilla risk, right? I mean, interest rate risk during a tightening cycle. This is why I'm saying it's emerging market banking 101. Yeah.
So okay, so you're saying the reason why SVB, Signature, and other smaller institutions got into trouble here is because they were not well regulated.
They don't have a diversified portfolio. Their balance sheet is completely, their asset side is completely filled up with these low return, debt, U.S. treasuries and stuff. So, I mean, you have to diversify. You have to have a diversified portfolio on the asset side. And then the liability side, they also have a problem with the liability side, right? They have the same type of depositors. This is the tech guys, right? This is why they became they caught up in this thing. All their depositors are same group. They texted each other, let's get out of this bank. And then their assets cannot, meet that type of all depositors going at the same time because it's not a diversified portfolio on the asset side.
Just to push back a little bit, some would argue, and I'm sympathetic to the argument, that it isn't about regulation so much as it's about the implementation of that regulation.
Supervision, no,
supervision.
I agree with that.
Supervision.
Yeah. Now let me clarify. In fact, one of my very early Bloomberg interviews on this topic, I did say exactly when this question was asked, is it regulation or supervision? I said it is supervision. So this is why I said, I might be abusing the word regulation, but the supervision, it is a failure of supervision, but I think supervision comes with regulation, right? I mean, if the regulation tells you, okay, you have to be supervised if you were taking interest rate risk or not, and it's kind of very, that's enforced, and supervision will come together with that. And okay, so, I'm supervising you, I look, and then you have so much interest rate risk on the balance sheet, so changes. But I mean, you see, they go together. It is a failure of supervision, I fully agree. But if the supervisor had no way of enforcing it, I mean, this is a story, right? I mean, we did actually heard that Federal Reserve of San Francisco did tell them this is not good. So they were warned, right? First Republic, definitely, that there was a warning sign, but they didn't do anything about it. So that's the thing. These things go together. It is a failure of supervision, but if a supervisor telling you, look, I don't like this, this is dangerous, then if the bank is saying, fine, I'm not going to do anything about that, then how are we going to get out of that situation? So that has to be some sort of enforcement mechanism.
Just looking, so going forward, so the system is financial system is still under significant pressure. I mean, the Fed has foot flat on the brakes, curves inverted, and other aspects of the operating environment that banks, are dealing with are more difficult. Credit quality is eroding, delinquencies, defaults are rising, loan growth, it's still positive, but it's definitely slowing. The tightening and underwriting is slowing loan growth. We've got higher regulatory costs. The FDI, the Fed and other regulators came forward with new capital standards and liquidity requirements, and that's going to be more costly. Supervisory costs are up. So you kind of add all of that up, and it says, okay, the banks, they're under a lot of pressure here, and it feels like something, as the longer this goes on, the more likely something's going to break somewhere. Is that a risk? I mean, how worried are you about that? Or am I just overstating things here?
No, there is a risk, but I don't think it is right to think that it is going to come from the bank side. I mean, banks are under pressure, banks are but I don't think that's going to be from that side, because banks, I mean, let's face it, after 2008, a lot of regulation rolled out. Banks now are in much better shape than they were in 2006 and 2007. So I don't think, again, unless like a huge shock happens like that, like, what happened then, everybody exposed to the same toxic assets, right? Unless we find out something like that going on, it is not going to come from the banking side just because Federal Reserve tightening monetary policy. Remember, this whole notion of Federal Reserve in a tightening cycle, so banks are going to break. I don't think this is correct. Yes, there are going to be some banks breaking. They already broke, right? But that's because of their own mistakes. So the system as a whole, like if we again compare to 2008, is, I think, safe. I think the danger is going to come from the real side, the real economy. And that is going to depend on, which loans they gave out, the banks, to who. I mean, if during this zero lower bound, super low interest rate era started in 2008-9, if they really gave out bad loans to bad customers, yes, then okay, obviously at some point the real economy is going to slow down, and those guys are going to start defaulting on those. And if the bank, again, on the asset side, similar to this the low yielding treasury story, if they literally focus on those type of customers, firms, and households, right? I mean, then yes, then of course we are going to have a problem at our end. But I don't think that was the case. Yes, banks did give out some, probably shaky loans during this cheap credit era. But I don't think it was that concentrated that everything is going to blow up at the same time. I think what is going on right now, and this is the question of soft landing, right? If Fed can engineer this soft landing immaculately till the end, right? Till we come down to 2%, sure, we are going to see some sort of defaults there and there, pockets of it. But as long as the entire SMEs, which by the way, 99% of all the firms in the United States, and they account for 70% of the employment in the United States. If that entire group, go under, if that doesn't happen, then we don't have a problem, right? We are going to see things, but we are not going to have like a huge crisis and recession, right? But that's the thing, right? And that comes back to soft landing. If the soft landing fails, and if somehow going now from 3.5 to 2 is going to involve very, very quick slowing down of the economy, so demand is kind of like crashing, then we are going to have a problem in our end, of course. And that's what we are all hoping won't happen. And Fed so far has been successful in that, but of course it's yet to be seen still. We are not fully there yet.
Just FYI to the listener, SME is small, mid-sized enterprise. So it's effectively small business. It's kind of the acronym. Mostly, I think European, maybe global, but not most people. Cris, do people here in the U.S. say SME? I don't know.
No, this is true. Yes, people say small businesses.
Okay. Right.
People say small businesses, but globally, SME,
that's what you mean.
Enterprises. But this is very important. I really want the listeners to understand. These guys always thought, oh, this is just a mom and pop shop, the pizza store on the corner, the dry cleaning. No, these are firms less than 500 employees. They are huge. They are 99.9% of the universe of the firms in the United States. Just to give you a idea, the average size in these firms are going to be something around 50 employment average. The average size of a listed firm is like 4,000. So I mean, these firms are day and night. The problem is the big guys is like 0.1% of the economy. In terms of employment, which is the big deal, of course, the SMEs run the show. I mean, remember the PPP program. When the PPP program launched, Paycheck Protection Program during COVID, the entire thing is that's for SMEs, right? To save firms under 500 employees. That was done to save the economy because these firms are the backbone of the economy in terms of growth, employment, and innovation. So we just ignore these guys because we don't know much about them because first of all, we don't know anything about their financing. They don't, they only file returns to tax records. So there isn't any publicly available data we can look at it. But they are very important. And if they go under in large numbers, yes, then of course we are going to have a recession in our hands. But as long as, not all the banks are in trouble. Some banks are in trouble, but not all of them. And as long as there's still semi-strong demand in the economy is not, going to a recession with flashing light, like high speed, these guys are not going to go under in bulk, in my opinion.
Okay. So what you're saying, just because I want to make sure I got it right, is you don't think if something does the economy in, it's not going to be the banking system or the financial system. That's not where this is going to come from. Yeah. It's something else has got to happen. What you're saying is, the banking financial system could have a problem. No doubt, but that's got to be because of something going on in the economy, and you're most focused on the small business or SME part of the economy. Okay. Yeah. All right. So I want to go on to talk about monetary policy because you kind of brought that up, and I think we should explore that. But before I do, let me turn to Cris. And Cris, what do you think? You want to have any comments on Sebnem's what she's been saying so far? Any pushback there?
I guess I was struck by this idea of regulation, that we need more regulation across the system. And that may very well be the case, but that's also, then I think you're also making a philosophical statement in terms of the structure of the banking. Do we have too many banks, right? Because if you increase the regulation on those smaller banks, you're going to see even more consolidation into a system that's more concentrated in these larger units. So if that's what we want, if that's what we think is optimal, that's fine. But I don't think we can have both. I don't think we can have much more regulation across the board and still maintain a very heterogeneous, diversified type of financial system. What do you think about that?
Yeah, no, I fully agree. This is something very fiercely debated in the literature, in academia and in policy circles both. And you can write down both models, right? You can write down a model where it is optimal exactly to consolidate, as you say. And you have, fewer banks. So we have the consolidation, but they are fiercely regulated, so we decrease the risk. Or you can also write down a model where it is optimal to have a heterogeneous, diverse system with many, many, many small players that keeps up the competition alive in the system. You can write down both models, and you can have an optimal policy coming out of both models. This is why we have our jobs, right? I mean, this is what we do in academia. I mean, write down these things, like competing models, and then go and test them in the data. I mean, this is exactly why data and granular data is super important. Micro data, bank level, household level, firm level data is super important to test these different models that will give you different optimal policies. And my view is, I think, we are, again, I mean, these risks, they kind of accumulate over time. And if you have too many small banks, and yes, there is a competition advantage, there is a heterogeneity diversity advantage, but there's also a big disadvantage that you don't see them, and then they can easily overnight turn into a big event, and then it is going to be harder to clean up the mess and all that. So this is a trade-off. You trade that risk with, you consolidate, you have a sharper bird eye, right, view, because you are going to regulate all these guys. Yes, now you decrease the competition because you might have a monopoly banking sector problem in your hand, but you're going to have a better handle on the risks in the system. So this is a trade-off, right? So which one you do? So I mean, and again, it is not clear. The answer is not clear. I agree with you.
I don't know if I've ever told you this story, but I started a company, an economic consulting firm that I sold to Moody's. Started with my brother and a good friend, and we sold it to Moody's about 15, 16 years ago. And we were a small company. Early on, we were expanding, growing quickly, needed a loan. So I go to I live in suburban Philly, so I go knock on the big regional bank. I won't tell you who it is; you'll figure it out. But I knocked on the door.
You can guess.
You can guess. Hey, I need a loan. The big regional bank said, "No, what are you're out of your mind? It's not going to happen." And if I were in their shoes, I'd probably say the same thing, because I had no assets. I had a home, probably had 5% equity in it. So fortunately, though, I was the coach of my daughter's soccer team, and on that team was a young lady whose dad was the president of Malvern Federal Savings Bank, 3 branches, Malvern, Pennsylvania. And he said, "I'll give you a loan," because he knew me personally, and he knew I would die before I wouldn't pay him back. It may take me 50 years to pay him back, but I would pay him back. I got the loan from Malvern Federal Savings Bank. So, from that experience, and obviously we're all in on data, Sebnem. I agree with you, but I like anecdotes as well. Based on that anecdote, I go, I kind of understand why we want a lot of small banking institutions, because they are really critical to those SMEs you were just talking about.
Yeah. Right? No, true. I mean, again, yes. I mean, so this is the difference between the startup SME and an SME, right? I mean, that you can be still small, but you can be a business in 20, 30 years, then you would get your loan from the large guy, right? So, but yes, if you're a startup, that is true. It's for small businesses that are younger than 5-year-olds. So there's a size issue and then there's an age issue, right? So this just, new guys are starting, like your case, Mark. It is important. You want that kind of neighborhood bank that either you have some sort of a personal connection, or you can go and plead your case. And yes, these guys are important. I'm not saying have JP Morgan buy out the entire industry and we go down to one bank. I'm not saying that, but at the same time, I mean, is 4,000 the optimal number? I mean, so this is the thing. This is something we need to study. I mean, maybe yes, we don't go to 60, but maybe it is 200. I don't know, but we do need to protect some of that very American, I'm going to go to my neighborhood bank, I will start up this business. We do need to keep that. I mean, that is very valuable. And yes, that is unique to America. I fully agree there. But at the same time, we need to find a way of better regulate, better supervise, right? Maybe think about ways of not having regulation costly, so we keep these guys, these smaller banks, but make sure we supervise and we enforce that they don't take these type of risks. So we have to find a better way here.
Yep, got it. Let's move forward to monetary policy, and you brought in the Fed. Here we are. The Fed has been raising rates now for about a year and a half. The funds rate target is 5.25% to 5.5%. What do you think? Are we kind of at the end of the rate hiking cycle here? Are we at the terminal rate, or is there more to go?
Yeah, I think we are at the end. I mean, so my terminal rate expectation has been now for some time. I mean, I have been saying this now almost 10 months. We are going to end somewhere between 5.5, 6. Shish. I don't expect to go over 6, but 6.
Ish. I like the ish part. The ish.
6 can happen. This is in my range. So maybe we will stop at 5.5. Right now we are 5.2, 5.5 range anyway. But we are at the end. I don't expect rate cuts though. So here where I differ from the financial markets. Financial markets are pricing in interest rate cuts way earlier than myself and some other fellow economists. But yes, we are almost there at the terminal rate, although I expect they stay here for some time in the absence of a very, very, harsh and deep recession. Again, this is the soft landing debate, right?
And do you have a view on that? Do you have a view on soft landing versus recession?
Yeah, so I do think Fed is going to succeed in this. I think it's going to be a soft landing.
Cris, do you hear that? Cris is the bear. I'm just. Okay. Did you hear that, Cris?
I am hopeful.
You're hopeful.
I hope that's the case.
Maybe
I'm a cheerleader.
That's also. I'm also a very positive and hopeful person, but I have been saying this now for some time, not just because I want it to be like that and be positive and hopeful, but because of the research we did. We did these very early papers on COVID inflation, starting as early as January 2021. Actually, we were in the group that says there is going to be inflation, but we also said, Larry Summers is right for the wrong reasons. In fact, FD worded exactly like that. That's us.
I'm right with you on that one.
Exactly.
Yeah. You're saying it's supply side, more supply
exactly,
side.
Supply side. So we said very early, and I had a presentation, like literally, WHO presentation, January 2021, before everything else. There's going to be inflation, but it's going to start with the supply chain, right? So it's going to start with the supply chain, with the product prices. I mean, now there's a new paper by Ben Bernanke and Olivier Blanchard. They also show the same thing. It's not wages first, the prices first. That completely links to the supply chain problem. This is global. Of course, this is not just United States. This is local supply chain, global supply chain going back to China. So we did the first paper on that. We did a second paper showing how, when fiscal stimulus came, put that on steroids, right? Yeah. You start with the supply chain problem, inflation starts. Then, of course, maybe you would have stayed at 5. You went to 9. Thanks to this huge fiscal stimulus, right? That's the demand side story. That's the second phase. And then, of course, the final phase, the Russia and Ukraine obviously added to that, more severely for Europe, of course. But now we document all these 3 phases of inflation, pandemic era inflation, starting with the supply chain issue, fiscal stimulus, of course, amplifies that, and then you add the energy. So we are coming down. So in that sense, we always told this can be a soft landing, right? Because the shock process is just very different. I mean, if people compare to 1970s, but I don't think that's the right comparison. That's just a part of it, right? You have a supply shock and a demand shock happening at the different times, and there is a sectoral dimension to this, and there's a global dimension to this, right? It's not just energy, or it's not just manufacturing sector. It is like the services, the labor market. I mean, the labor market came to the picture because of course, the huge demand increase in the services sector, which combined with the recovery and opening up. So given all this research, I always told, a credible tightening cycle, clearly communicated, right? Which is what Fed was trying to do, which, by the way, and we should all give it to Fed, very hard to do, because you get out of forward guidance and you go to a data-driven policy, communicating clearly a data-driven policy is extremely difficult to financial markets, because financial markets are forward-looking and they want to know the right? They want to know the future. So that's how they were. And then you go and say, well, I'm going to look at the data and I'm going to look at 6 different indicators of the labor market and the energy and so all this is very difficult to communicate. But basically the research we have done says such a different environment with several shocks happening different times in the economy, and a clearly communicated and consistent tightening cycle can, engineer a soft landing. So in that sense, our research never hijacked by this, Phillips curve story, because if you always think in terms of the Phillips curve and say there's just this slope and it was flat, now it is steep, this is limiting to us in our view. So we work with these network models. These are also very complicated models, but basically you can connect every single sector to each other locally and globally. So, when basically you don't import steel from China, the effect of that in the steel sector and then the labor steel sector uses and the wage growth, we can quantitatively trace this out. So in that sense, we really like our research, of course, but stand behind it that this is the best way, in our view, this is the best way to quantify what, drove inflation when in 2020, 2021, 2022. And then once you do that quantification, you can see that, why Fed is going very careful and why they keep talking about these different sectors of the economy, right? Remember, they said okay, so there's the headline, the core, and then you peel that, the famous onion analogy of John Williams, New York Fed president, and then there is the PC, then there is the X shelter one, and there is the, so all these is because of the nature of this shock. And Fed has been right in looking at this all along, because the nature of the shock is you have different sectors being hit different times with different shocks. And then you also add to that the global dimension of the problem. It is a very, very complicated problem. And
not really. Not really.
Really, Mark.
No, come on. You get a pandemic, you get supply chain disruptions, it messes up the labor market. You get a Russian war in Ukraine, oil prices go skyward. Food,
okay.
That's pretty straightforward, in my view.
The narrative is very straightforward. I fully agree. But to get a handle on that in terms of quantification with numbers, difficult. Why? Because of the models, the Fed works with.
You're saying disentangling the supply shocks from the demand shocks isn't.
And also how long it takes, and also so. Recall the debate. The debate in the past 15 months has been about that. How long it takes?
Okay, so Sebnem. So you said all this, but why does the funds rate have to go to 6% then? The pandemic and Russian war effects are fading. They're in the rearview mirror. Inflation's coming in, feels pretty good. All the trend lines look good. The things you can forecast in inflation with some certainty, like the cost of housing services or vehicle prices, we know they're coming in. So why?
No, it may not have to, but this is about my complicated thing, because if you try to guess at if you try to estimate the terminal rate and when you stop based on your one sector aggregate Phillips curve model, you cannot get an exact.
No. But that's
okay. But you and I, we understand it.
We're on the same page. Obviously, the Phillips curve is not pertinent here. We're at 3.5% unemployment rate for a year and a half, and inflation's coming in.
Okay, but this is why. Okay, but Mark, now let me push back. This is why I said it's complicated, because complicated means you have to be thinking about sectoral Phillips curve. If you start thinking about sectoral, there, even like you do a fairly, decent aggregation, you are going to be dealing with 66 sectors in the United States economy. You open up globally, this is going to explode, right? And you are going to now think about those, 66 Phillips curve. This is complicated. Complicated in the sense that you are trying to estimate an aggregate number based on that. So it is
okay. Fair enough. Okay, fair enough. Yeah, that is complicated. 66 times 73 countries.
Exactly.
Okay, fair enough.
Exactly.
All I know is it feels like inflation's coming in as these supply shocks begin to fade.
Exactly. No, you're exactly. So we may not have to go to 6. We may not have to go. But this is exactly what they are trying to, right? They never wanted to do more than they needed, but at the same time, they want to do enough that they wouldn't be in a position of, oh, we didn't do enough, and the risk of that having the inflation, messing up the inflation expectations and becoming sticky is bigger, right? So this was the very delicate dance they were trying to do the last 15 months, and we might stay at 5.2, 5.5, Mike. And this again goes back to data-driven policy, right? Now, this data came out great this week. The next piece of data coming like that, so we are in the right trend, they are going to stay. They are not going to go to 6. So, but this is exactly what I think they mean with data-driven policy making.
Well, I'm all in on data. We're big fans of data. In fact, I think you use a lot of our data, Orbis data set. That's our data. That's our data, by the way. So
yeah, I know. It's like your data. I'm a big fan
so
of
we're all in on data. We're gonna bring it on, baby. I think we've taken enough of your time. I really appreciate you coming on the podcast. I'll have to say I feel a lot better. I actually still am, but I'm a little less concerned about the banking system. I feel like that could still be an issue, and I'm glad we're on the same page. And the listeners should know I didn't know what your view was on inflation before I had you on, but I was glad to hear it. But I really do appreciate your optimism, and I'm very sympathetic to it. So thank you for coming on.
Thank you so much. This was great. Thanks, Mark.
I appreciate that. And with that, dear listener, we are going to call this a podcast. Take care now, everyone.